There's a legal scam happening in America right now, and you are almost certainly a victim. It is not hiding in the shadows. It arrives in your mailbox every month disguised as protection. Insurance companies have figured out exactly how to terrify you into buying coverage you do not need while riddling the coverage you do need with loopholes designed to deny your claims. They employ armies of actuaries and lawyers whose entire job is ensuring they collect maximum premiums while paying minimum claims. You are not their customer. You are their profit margin. And the traps they have set for you are costing thousands of dollars every single year. Today I am exposing their entire playbook and showing you exactly how to stop being their victim. I want to be clear about something before we dive in. Insurance itself is not a scam. Proper insurance is essential. It protects you from catastrophic financial losses that could destroy everything you have built. The scam is how insurance is sold. The scam is unnecessary coverage pushed through fear. The scam is strategic loopholes buried in policies. The scam is an industry that profits most when you understand least. By the end of this video, you will know exactly which insurance traps are draining your bank account and precisely how to escape them. This information could save you thousands of dollars annually while actually improving your protection against real risks. Subscribe and hit that like button right now because the insurance industry spends billions hoping you never learn what I'm about to teach you for free. Let me start with the trap that catches almost everyone: the extended warranty and protection plan scam. You buy a new television. The cashier asks if you want the protection plan. Only $150 for 3 years of coverage. Your brain calculates the risk. What if something goes wrong? What if the screen cracks? What if it just stops working? The fear kicks in. You say yes. Here is what they are not telling you. Electronics either fail immediately due to manufacturing defects which are covered by the manufacturer warranty, or they last for years beyond any protection plan period. The window where an extended warranty would actually help is incredibly narrow. Studies show that only 2 to 5% of extended warranty purchasers ever file a claim. The other 95% paid for nothing. Retailers push extended warranties aggressively because profit margins reach 50 to 70%. That $150 protection plan costs them maybe $40 to service statistically. The rest is pure profit extracted from your fear of unlikely scenarios. The same trap exists at car dealerships: paint protection, fabric coating, gap insurance at dealer prices. Extended mechanical warranties. These add-ons can pile $3,000 to $5,000 onto your purchase. Dealers love them because they often make more profit on add-ons than on the vehicle itself. Your fear of future problems funds their bonuses. The solution is simple. Self-insure for small, replaceable items. That television will be outdated and cheap to replace by the time it fails. If you cannot afford to replace something without insurance, you probably cannot afford to buy it in the first place. Reserve insurance for catastrophic losses you genuinely cannot absorb, not for minor inconveniences. The second trap exploits your love for your family in the most manipulative way possible. Unnecessary life insurance on children. Insurance agents love selling whole life policies for children. They pitch it as building cash value, locking in insurability while they are young and healthy, creating a financial gift for their future. It sounds responsible. It sounds loving. It sounds like something a good parent would do. It is almost always a waste of money. The purpose of life insurance is replacing income that dependents rely upon. Children do not have income. Nobody depends on their earnings. The death of a child is emotionally devastating, but not financially catastrophic in the way that losing a working parent would be. A typical whole life policy on a child costs $50 to $100 monthly. That money invested in an index fund averaging 10% returns would grow to over $100,000 by the time the child reaches adulthood. The insurance policy cash value would be a fraction of that amount. If you want to build wealth for your children, open a 529 education savings account or a custodial brokerage account. These vehicles actually grow wealth efficiently. Whole life insurance on children primarily grows wealth for the insurance company and the agent who sold it. The third trap targets your vehicle and costs the average driver hundreds of dollars annually without providing meaningful additional protection. Exposed insurance on older vehicles is one of the most common insurance mistakes in America. Collision coverage pays to repair your vehicle if you cause an accident. Exposed coverage pays if your car is stolen or damaged by something other than a collision. Here's the math nobody does. If your vehicle is worth $5,000 and your deductible is $1,000, your maximum possible payout is $4,000. But you are paying maybe $400 annually for that coverage. In 10 years, you pay $4,000 for the possibility of receiving $4,000. You are guaranteed to lose or at best break even. The rule is straightforward. If your vehicle is worth less than 10 times your annual comprehensive and collision premium, drop that coverage. Keep liability coverage always because that protects you from lawsuits. But stop paying to insure a depreciating asset that costs more to cover than it is worth. When I applied this rule, I saved over $600 annually on a vehicle worth $8,000. That money now flows into investments instead of insurance company profits. The fourth trap hides in your homeowner's or renter's policy and could leave you devastated precisely when you need protection most. Exposed coverage occurs when your policy limits fail to match your actual replacement costs. Insurance companies love this because they collect full premiums but owe reduced payouts when disaster strikes. Your homeowner's policy might show $300,000 in dwelling coverage, but construction costs have exploded in recent years. Rebuilding that same house today might cost $450,000. You are underinsured by $150,000. When your house burns down, you discover this gap at the worst possible moment. The same applies to personal property coverage. Standard policies often cap certain categories. Jewelry might be limited to $1,500, electronics to $5,000. If your engagement ring is worth $8,000 and your electronics total $15,000, you have massive exposure you probably do not know about. Request a replacement cost review from your insurance company annually. Construction costs change. Your possessions accumulate. Your coverage must keep pace or you are paying premiums for protection that will not actually protect you. The fifth trap sounds responsible and protective but often provides terrible value for the premium charged. Accidental death and dismemberment insurance is sold through employers' credit cards and direct mail campaigns. It seems cheap, maybe $10 monthly. It only pays if you die or lose limbs in an accident. Here is the problem. Accidents cause only about 6% of deaths. If you die from cancer, heart disease, stroke, or any illness, this policy pays nothing. You need income replacement regardless of how you die, not just if you die in a specific way. A proper term life insurance policy covers death from any cause. It costs marginally more than AD&D insurance but actually provides real protection. That $10 monthly for AD&D could instead be $20 monthly for actual term life coverage worth 50 to 100 times more in practical protection. The insurance industry loves AD&D because they rarely pay claims. The specific circumstances required for payout are statistically uncommon. Your premiums are almost pure profit for them. The sixth trap exploits confusion about health insurance in ways that cost families thousands annually. Exposed health plans have flooded the market. Short-term health insurance, health-sharing ministries, fixed indemnity plans. These alternatives to traditional health insurance are marketed aggressively to people frustrated with high premiums. They are not real health insurance. Short-term plans can deny coverage for pre-existing conditions. They often exclude maternity. Mental health coverage is minimal or absent. Lifetime and annual limits exist that real health insurance cannot impose. When you actually get seriously ill, these plans evaporate, leaving you with massive bills. Health-sharing ministries are not insurance at all. They are not regulated as insurance. They can reject claims for almost any reason. Members have sued after having hundreds of thousands in medical bills denied. Fixed indemnity plans pay a fixed amount per day or per incident regardless of actual costs. 3 days in the hospital might cost $90,000. Your fixed indemnity plan pays maybe $3,000. You owe the rest. The savings on premiums vanish instantly when you actually need care. One serious illness or accident reveals these plans as the financial traps they are. Stick with ACA-compliant health insurance even if premiums are higher. The protection is real. The seventh trap takes advantage of your fear of disability in a way that provides minimal actual security. Employer-provided disability insurance sounds like a valuable benefit. Your company offers short-term and long-term disability coverage. You feel protected. You probably are not. Exposed employer disability policies typically replace only 50 to 60% of your base salary. Bonuses and commissions are often excluded. After taxes, your actual replacement income might be 40% of what you currently earn. Could you survive on 40% of your income? Additionally, employer-provided benefits end when employment ends. Lose your job and lose your disability protection simultaneously. If you become disabled while unemployed, you have nothing. Individual disability insurance that you own and control provides far superior protection. Benefits can reach 70% of income. You own the policy regardless of employment status. Certain policies even pay for partial disabilities that employer plans might not cover. The cost is higher than employer-provided coverage. But disability is actually a significant risk. 1 in 4 workers will experience a disability lasting longer than 90 days before retirement age. Proper protection is worth the investment. The 8th trap is one of the insurance industry's favorite profit generators. Exposed deductible traps occur when you choose low deductibles thinking you are maximizing protection. The opposite is actually true. Consider 2 auto insurance scenarios. Policy A has a $250 deductible and costs $1,800 annually. Policy B has a $1,000 deductible and costs $1,200 annually. You save $600 yearly with the higher deductible. In just over 1 year of savings, you have already accumulated enough to cover the difference if you need to file a claim. After 2 years, you are ahead regardless of what happens. Most people file auto insurance claims rarely, maybe once every 7 to 10 years on average. Over a decade, the low deductible policy costs you $6,000 extra dollars. The high deductible policy lets you keep that money. If you file one claim during that period, you pay an extra $750 out of pocket, but you saved $6,000. Net benefit $4,500. The same math applies to homeowners insurance. Higher deductibles mean lower premiums. The savings compound over years of claim-free coverage. Self-insure the small stuff. Let insurance cover the catastrophes. The 9th trap catches people trying to be responsible by over-insuring against unlikely scenarios. Duplicate coverage wastes money when multiple policies cover the same risk. This happens more often than you realize. Your credit card offers travel insurance. You also bought a separate travel insurance policy. You also have coverage through your health insurance and homeowners policy for many travel-related incidents. Triple coverage means triple premiums for single protection. Your auto policy includes medical payment coverage. Your health insurance also covers auto accident injuries. You are paying twice for the same protection. Your renter's insurance covers personal property. Your parents' homeowner's policy might still cover your belongings as a dependent. Check before buying duplicate coverage. Review all your policies together at least once annually. Create a coverage map showing what each policy protects. Identify overlaps and eliminate the redundant coverage. This single exercise saves the average household $200 to $500 annually. The 10th trap is perhaps the most insidious because it relies on your inertia to extract maximum profit over decades. Never shopping your insurance is the most expensive mistake of all. Insurance companies use a strategy called price optimization. They gradually increase premiums on existing customers who do not shop around. They know switching requires effort. They bet on your laziness. Studies show that loyal customers often pay 20 to 50% more than new customers for identical coverage. Your reward for years of loyalty is being charged more than someone who just signed up yesterday. Shop your insurance annually, every single year. Get quotes from at least 3 competitors. Use this leverage to negotiate with your current provider or switch to someone offering better value. I saved over $800 on auto and home insurance last year simply by spending 2 hours getting competitive quotes. My coverage actually improved while my premiums dropped. The only thing I lost was loyalty to a company that was exploiting that loyalty. Let me give you the action plan that ties this all together so you can immediately stop bleeding money to insurance traps. This week, pull out every insurance policy you own. Auto, home or renters, health, disability, everything. Read the declarations page showing your coverage limits and premiums. Eliminate unnecessary coverage. Extended warranties. Child life insurance. AD&D policies. Collision and comprehensive on older vehicles. Cut what provides no real value. Identify dangerous gaps. Underinsured home replacement costs. Inadequate liability limits. Insufficient disability coverage. Fix these gaps because they represent real risk. Raise deductibles strategically. Move to higher deductibles on auto and homeowners insurance. Bank the premium savings to cover future deductibles if needed. Eliminate duplicate coverage. Map your policies against each other. Remove redundancy wherever it exists. Shop every policy competitively. Get quotes from multiple insurers. Do this annually without exception. These steps take perhaps 4 to 6 hours total. The savings range from $1,000 to $5,000 annually depending on your current situation. That is an effective hourly rate of $200 to $1,000 per hour for your time. The insurance industry survives on your confusion, fear, and inertia. They need you afraid of everything so you buy unnecessary coverage. They need you confused so you miss the gaps in necessary coverage. They need you passive so you never notice premiums rising. Today you became dangerous to their business model. You understand their playbook. You see their traps. You know how to protect yourself without overpaying. If this video saved you money, share it with someone you care about because they are probably being exploited by these same traps. Subscribe and hit the notification bell because I expose the systems designed to drain your wealth and teach you how to fight back. Drop a comment telling me which insurance trap was costing you the most. Stop being their profit margin. Start being the person who actually understands what they are buying. Your money, your protection, your rules now. I will see you in the next video.